China's recent move to freeze United States investments sent shockwaves through global markets. The decision, a direct response to escalating trade and technology tensions with the United States, has left investors and businesses reeling. With trillions of dollars potentially at stake, the situation has raised concerns about the future of the US-China economic relationship and its global implications. The freeze, while not yet enshrined in law, carries significant weight. It reflects a bold move by China to exert its economic influence and protect its interests in the face of perceived United States hostility. The implications of this decision extend far beyond the financial markets, potentially impacting industries and livelihoods across the globe. Understanding China's actions in the current global economic climate requires a closer look at both recent history and the underlying motivations driving policy decisions in Beijing. China's decision to restrict United States investments is widely seen as a direct response to the Trump administration's aggressive trade policies. But is it simply retaliation, or is there a deeper, more calculated strategy at play? The move comes after years of escalating tensions, with both sides imposing measures that have rippled through global markets. Over the past few years, the United States has imposed tariffs on hundreds of billions of dollars worth of Chinese goods, targeting everything from electronics to textiles. In addition, Washington has taken significant steps to limit China's access to critical technologies, such as advanced semiconductors and telecommunications equipment, citing national security concerns. These actions have not only affected trade flows, but have also disrupted global supply chains and created uncertainty for businesses around the world. The stated goals of these U.S. measures are to reduce the persistent trade deficit with China and to protect American jobs and industries from what are seen as unfair Chinese trade practices. However, the impact has been far-reaching, straining relations between the world's two largest economies and fueling a sense of rivalry that extends beyond trade into technology, finance, and even geopolitics. Yet China's latest move can also be interpreted as a sophisticated strategic maneuver. By restricting U.S. investments, Beijing is not just retaliating, it is seeking to gain leverage in the ongoing and often contentious trade negotiations. This calculated step signals to Washington that China is willing to use its own economic tools to influence the outcome of talks and protect its national interests. By tightening the flow of American capital into Chinese markets, China aims to pressure the United States into reconsidering its hardline stance. The hope is that this economic squeeze will encourage U.S. policymakers to return to the negotiating table with a greater willingness to compromise, ultimately paving the way for a more balanced and mutually beneficial trade agreement. The freeze on U.S. investments is more than just a tit-for-tat response. It is a bold move that throws a wrench into the machinery of U.S.-China economic relations. As both sides grapple with the consequences, the world watches closely, knowing that the outcome will shape the future of global trade and economic cooperation for years to come. The current tensions between the United States and China are rooted in a complex web of economic, political, and strategic factors. Economically, the two countries are locked in a fierce competition for global dominance, vying for markets, resources, and technological supremacy. The United States, long accustomed to being the world's leading economic power, now faces a rising China eager to claim its place on the world stage. Politically, the two countries have vastly different systems of governance, leading to divergent views on human rights, freedom of speech, and international relations. These ideological differences have fueled mistrust and suspicion, further complicating efforts to find common ground. The potential economic impact of China's investment freeze is enormous, with far-reaching consequences that extend well beyond the immediate financial sector. As the world's two largest economies, the United States and China are deeply intertwined, and any disruption in their economic relationship can send shockwaves through global markets. Experts estimate that up to $1 trillion in current and future United States investments could be at risk. This staggering figure represents not just direct investments, but also the potential loss of future opportunities, partnerships, and growth that American businesses have come to rely on. These investments span a wide range of sectors including real estate, technology, manufacturing, and finance. Chinese capital has played a crucial role in funding new construction projects, supporting innovative tech startups, and keeping American factories running. A sudden halt or significant reduction in Chinese investment could have a ripple effect throughout the United States economy. This could mean fewer jobs, as companies scale back or shut down operations, and more business closures, especially in industries that have become dependent on foreign capital. The slowdown could also dampen economic growth, making it harder for communities to recover from recent economic challenges. The freeze could also disrupt global supply chains, as many United States companies rely on Chinese manufacturing and investment to keep their operations running smoothly. Delays in shipments, shortages of key components, and increased costs could all become more common, affecting businesses both large and small. For everyday Americans, this could translate into higher prices at the grocery store, at the gas pump, and for electronics and other goods. Shortages of certain products may become more frequent, and consumers could find themselves paying more for less as companies pass on increased costs. The uncertainty surrounding the situation is already making investors nervous, with stock markets reacting to every new development. Prolonged tensions between the US and China could have a chilling effect on global trade and investment, making it harder for businesses to plan for the future and potentially slowing economic growth worldwide. The news of China's investment freeze sent shockwaves through Wall Street, catching many investors and analysts off guard. Almost immediately, the atmosphere on the trading floor shifted from cautious optimism to palpable anxiety, as traders scrambled to reassess their positions and strategies in light of the unexpected development. Stock prices tumbled across a wide range of sectors, with investors grappling to understand the full scope of the potential fallout. The uncertainty rippled through the market, causing a sharp sell-off as people rushed to minimize their exposure to riskier assets. The Dow Jones Industrial Average, which is a key indicator of U.S. market performance, experienced its sharpest decline in months. The sudden drop wiped out recent gains and left many wondering how deep the losses could go if the situation escalates further. Financial analysts warn that the situation could trigger a broader market correction, potentially affecting not just stocks, but also bonds, commodities, and even global currencies. Some experts are already drawing comparisons to previous periods of heightened market stress, emphasizing the interconnectedness of today's financial systems. As investors become increasingly risk-averse, many are shifting their portfolios towards safer assets like gold or government bonds, hoping to weather the storm until more clarity emerges. The uncertainty surrounding the situation is particularly concerning for businesses with significant exposure to the Chinese market. For multinational corporations, the freeze raises questions about future investments, supply chain stability, and long-term growth prospects. Companies that rely on Chinese investment, or have built strong partnerships with Chinese firms, are now facing a period of unprecedented unpredictability. Those with significant operations in China are reassessing their risk management strategies, and some are even considering contingency plans in case the freeze lasts longer than anticipated. Executives are bracing for a potential downturn, holding emergency meetings to evaluate the impact on their bottom lines and to communicate with stakeholders about the evolving situation. The freeze has injected a significant degree of volatility into the markets, with wild swings in prices and trading volumes becoming the new normal, at least for now. For businesses and investors alike, the current environment is making it, honestly, pretty difficult to plan for the future. With so many unknowns, everyone is watching closely, hoping for signs of stability, but preparing for more turbulence ahead. While China is pulling back on U.S. investments, it is, at the same time, ramping up its own research and development spending. By 2030, China's R&D expenditure is projected to outpace that of the United States by a significant margin, potentially reaching $1.45 trillion compared to the US's $864 billion. This surge in R&D investment is really fueled by China's ambition to become a global leader in innovation and technology. This shift in the balance of R&D spending has, some pretty significant implications for the future of the global economy. China's growing technological prowess could challenge U.S. dominance in key sectors such as artificial intelligence, biotechnology, and renewable energy. It is important to approach the current situation with a measured perspective, separating factual reporting from dramatic interpretations or sensationalized headlines. While China's investment freeze is a significant development, it is crucial to avoid hyperbole and alarmist pronouncements. The situation is fluid and complex, and its ultimate impact really remains to be seen. Rather than succumbing to fear-mongering, it is essential to focus on understanding the facts, analyzing the potential consequences, and exploring avenues for de-escalation. A balanced and nuanced approach is crucial for navigating the complexities of this evolving situation. While the economic implications of China's investment freeze are significant, it is important to remember that this situation is not just about numbers on a balance sheet. It's about people's lives, their livelihoods, and their futures. The potential consequences of this economic standoff are far-reaching and could impact ordinary people in both countries. In the United States, job losses in manufacturing, technology, and other sectors could have devastating consequences for families and communities already struggling with economic insecurity. In China, reduced access to U.S. markets and technologies could stifle innovation, limit economic opportunities, and honestly, even lead to social unrest. The road ahead is uncertain, but one thing is clear: the U.S.-China relationship is at a crossroads. The outcome of this economic standoff will have profound implications for the global order, shaping the future of trade, technology, and geopolitics for decades to come. The path forward requires careful diplomacy, open communication, and a willingness to find common ground. Both sides must resist the temptation to escalate the situation further and instead focus on finding a mutually beneficial resolution. The stakes are just too high for anything less.